So my journey began with a mom, a brother who was Bryce's age, and a dog. We had a bird dog named Radar, and my mom decided to teach us landscaping. So we drove around southeast Georgia with a mom, a dog, and a brother, and a 15-year-old learning landscaping. Before you knew it, my brother and I were making more money than my mom and dad. It's pretty amazing. And whenever we began making money, we started reading books like Robert Kiyosaki's Rich Dad Poor Dad. I'm sure you've read that book. Or Dave Ramsey's A Total Money Makeover. So I went to meet with the financial guy, right? Everybody's got a financial guy. This financial guy says, whenever you make more money and you can save more money, come back and see me. I got to tell you, that rubbed me the wrong way. I was already making more money than my dad, who had been in the workforce for more than 30 years, and my mom, who was a master's level nurse. And we got to make more money before I can learn how to, quote, invest. Needless to say, I learned real quick that I didn't like Wall Street. I'm not a big fan of Wall Street. You're like, Justin, you work in the Wall Street world. Yeah, but I work with business owners. My primary focus is helping business owners double their net worth every 3 to 5 years. That's the goal. Like, that's impossible. No, it's not. We're going to go over it today. In fact, what I'm going to show you today is the thesis or the inside of the next book, How to Grow the Value of Your Company. So what I'd like to set the stage with, if I can use this machine here, is first give you some context. We've all seen charts like this that financial people try to get us to, as this guy said, whenever you make more money, come back and we'll put it into the stock market. And those are the stock market returns. Pulled that off of one of the popular sites. Whenever I look at that as a business owner, I got to tell you, I have a hard time settling for a 16.93% return in 2019 whenever this is printed. I have a hard time doing that. I have a hard time settling, pick a number inside, 26, that's a pretty cool number back in 2013. I have a hard time settling for a 26% return on my investment. A hard time with that. Why? Because I realize as a business owner, my single largest asset is my business. And so, yeah, we can make more money in our businesses. I'm going to make a statement here, and I'm going to qualify it a little bit later. There's not a business that I've seen, and I've seen almost hundreds, if not thousands, of businesses that cannot double the enterprise value within 3 years. Think about that. Can a financial person, whoever they are, say, I've never seen a portfolio that can't double in 3 years? No, it's ridiculous. Can't say that. But I've yet to see a business that can't double the enterprise value in 3 years. So we can make more money in our businesses as business owners. That's the idea behind it. Here's some sobering news, though. What happens, as I see it, is business owners, we spend our entire life just busting it. I mean, like this morning I was up at 4 a.m. doing some, in fact, one of the team members, Jim Tatar, said, Justin, I got like 15 emails. Was it a mistake? I'm like, no, I was working this morning. Business owners, we're busting it day in, day out. What's the old saying? We'll work 80 hours a week for ourselves as opposed to working 40-hour a week for the man, right? We do that to our own demise many times. In fact, if I look at a personal financial statement or a net worth statement for a lot of our business owners, the single largest asset on their financial statement is their business. And if I compare that to the stock market or to an annuity or something else that some planner has sold them, it pales in comparison of size. So I realize that if my single largest asset is my business, then it behooves me to learn how to grow my single largest asset. One of the most shocking things is that not only is 80% of our net worth tied up in our businesses, but the statistic being that so many businesses never sell. Whenever I sold my first business, it was the landscaping business my brother and I started. We sold that and paid our way through college with the proceeds. We put an offer out, we listed the business, and we started receiving LOIs, or letter of intents. Man, I was shocked on how much this business was worth. I thought it was worth so much more than that. In fact, there's a couple of members of the Legacy Centers that I've spoken with in the last 4, 5, 6 months that whenever they received offers, they're like, man, I thought my business was worth more than that. Well, see, here's the problem on the screen behind us. We're looking at our business in a microcosm in a very small niche, and we can't often see the big picture. In fact, if I knew what I knew today back 30 years ago when I sold that first business, if I had just given about 3 to 4 months of time, I know I could have doubled the sales price. I know I could have, just with my knowledge today. But we business owners don't think about that. Why? Because we're so busy working in our business. We're going to come to some statistics in a second about how us business owners get bogged down in our business. But one of the problems is who's sitting across from us. I was talking with a guy yesterday, and he said, Justin, I received an offer for 4 times. Like, 4 times what? He said, I got 4 times, man. That's a great offer. I said, are you talking about revenue? Are you talking about EBITDA? Are you talking about percentage of margin? Are you talking about EBIT? What are we talking about? 4 times what? I don't know. I don't have a clue. See, what happens is many times as business owners, we are sitting in chat rooms with peers. We're at our trade shows. We're listening to other individuals in our own industry, or sitting around Thanksgiving table talking to mom and dad, or talking to Cousin Joe or Cousin Eddie, I hope not. We're talking to folks around us, right? And they're throwing things at us that, well, so-and-so over there did this. We never look at it from a micro environment. We always look at it from macro. Well, if it worked over in Kansas, it's got to work here in East Tennessee. Not necessarily the case. So one of the challenges that we have as business owners is who is our trusted advisor? Who is that person sitting across from the table preaching into our ear that we're able to actually utilize their information? A lot of us end up not thinking strategically about that. The inefficiency of the market, if this will come up here, is that, I'm going to go ahead and push this through for sake of time, is that only about 3 to 4% of businesses actually sell for what the business owner thinks they're worth. So the statistics are as follows, okay? Currently, there's about 5.7 million businesses in the United States that employ people. Out of those 3.5 million businesses, there's roughly about 350,000 middle market businesses. Middle market being they produce between $10 million and $100 million of annual revenue. Most businesses fall under $10 million of annual revenue. In fact, there's 4.2 million business owners which produce less than $10 million of revenue. So the numbers on the small market, what we call the micro market, are very, very nebulous because it's very private. In the middle market, we can actually get some statistics. So here's some statistics on the middle market. And by the way, if you drop it down to the micro market, it's even worse than what I'm showing you here. So in the middle market, if we have roughly 350,000, we realize that 250,000 of those, 3/4 of those, are going to try to go to market and sell within the next 10 years. Why? Well, because of the Great Recession. Those individuals who were getting ready to sell, coming into the Great Recession, they had to push themselves back a little bit to recover their financial statements, and we're just now starting to see that happen with the economy as it stands today. And so, because of that compression of age, demographic, et cetera, there's a huge amount of businesses going onto the marketplace. Out of those individuals going to the marketplace, look at the numbers. Roughly 30,000 of those will actually sell, will actually transact. Now, that could be to a third party. That could be to an individual party within the company. That could be to a family member. But the numbers are mesmerizing. If we drop it down to the micro market, which is where most of East Tennessee business is, it is devastating. Then to say, okay, that 80% of my net worth, 80% of that may not ever move from an illiquid asset to a liquidity event. No wonder business owners don't retire until they're dead or until about 5 or 10 years left before retirement. Because we can't cash out. We can't move an asset from an illiquid position to a liquid position. Whenever you look at that, one of the problems that we have is a gap. And this is where a good planner comes into place. If I'm a business owner, we are trained by our illustrious CPAs to push as much business expenses through the business as possible. And we actually try to minimize our taxes. Some of us are so good that we minimize our taxes that your best friend, your banker, makes you have to actually donate a goat to get a loan because you have no income. So I can throw things back, so we go back a long ways. But some of us are so good, we get our income way down to where it doesn't exist. But then we go to try to sell the business, we don't realize actually the amount of money we utilized through that business. There's actually a process called the normalization of a P&L or normalization of a balance sheet that lets us look at how much we business owners actually spend through our business, not just on our paycheck and our net income. Whenever we look at the amount of money we spend through our business and compare it to our business value, oftentimes the sales price of our business is not high enough to support the retirement proceeds we need. There's a gap. It's called a value gap. Whenever you deal with the value gap, one of the keys that we have to realize is in order for us to close that gap, the amount we need our business to sell for to hit our retirement goals and where we're at today can methodically be filled. We can grow our businesses and our net worth and our liquid positions in a way that we can sustain that retirement, so to speak, that many of us want to achieve. So you can close the value gap. What happens, though, is so many, I don't want to say this, consultants, advisors come out of corporate America. I see this all the time. We have these individuals who retire at 40, 50, 60 years old. They worked at some executive position, maybe a district manager somewhere. And if you're in this room and you're that way, I'm throwing stones, so just take it easy here. Well, they come out and they say, hey, look, we ran a profitable division of this company. Let's use GE because I kind of like Jack. So we run a profitable division at GE, and we know what worked in GE, so we're going to come out and we're going to teach consulting. We're going to consult with you small business owners, and you need to do exactly what we did at GE. Folks, it doesn't work. It doesn't work. We see it on a regular basis. What we business owners try to do whenever we start seeing this crazy advice from these business consultants is we say, time out, let's go chase revenue. Oh, we got to increase sales. We got to increase our sales. If we increase sales, then we can surely increase the value of our company. That's a huge, huge danger. It's actually, think about it this way. I'm an old country boy. I try to use little analogies. If you listen to the podcast or whatever, I have all sorts of fun things out there. But everybody in here would recognize a water hose, I hope. Okay? We would recognize that if you have a water hose and you're trying to water that tomato, man, we had some cool tomatoes. Does anybody else have good tomatoes this year? We had some great tomatoes this year. If you're trying to water that tomato plant, if that water hose is kinked, you're not going to get the flow through that water hose that you need to get the pressure to water the tomato. You just can't do it. So what do? We don't go over and turn the water up even higher, with some of us may. We have to go and kink the hose. We have to straighten the hose out. We have to make sure there's no holes in the hose. If we go after, as business owners, trying to solve our retirement problem, if we go after trying to solve our value problem of our business by pushing more pressure or trying to push more flow, more sales through our business, all we're doing is exacerbating the problem. We're going to get to a term called company-specific risk. Just for my information, has anybody here ever had a valuation done or seen a valuation? Raise your hand. Okay. Whenever you deal with a valuation of a business, one of the key factors for that valuation is a term called company-specific risk. We're going to deal with that immensely. So my promise is, first of all, you're never going to hear another Wall Street guy talk like me. Promise you that. I'm going to throw them all underneath the bus because they drive me crazy. Second thing is you're going to learn something today, I hope. Hope I can. There's some pretty smart folk in here, though. The goal is to quantify, is to chase quantifiable results. What if it was possible today to look at a valuation and say that value came in at $1 million, whatever the number is, and if you did these systematic 16 steps for your company, you can increase that twofold. Not trying to put more revenue in the top line. Talking about the way the valuation calculator works within a valuation software. What if we could change the factor? So just for basic information purposes, whenever you go to a valuation of a company, you're trying to figure out what your company's worth. I'm going to oversimplify this, and the CPAs are fixing to cringe. You're looking at revenue, let's call it EBITDA, okay? And there's typically a factor. It may be a factor of 3. Some people call it the super 5. So let's say the EBITDA of a company is $100,000, and we're using a super 5 factor, so a factor of 5. So that means that company, 100 times 5 is $500,000. That'd be the value of that particular company. In entrepreneur doctors, like a dental practice, they would look at the trailing 12 months. So let's say it was a $100,000 trailing 12 month of collections, times a multiple of 70, 80, 90, 100, 110%. So it depends on what industry you're in is how they're going to factor that out. But for simple solutions today, we know that if we realize our revenue and the factors, the percentage factor is what drives our value. And we have the option to increase our revenue. We could go out and double the revenue. We could go out and double the sales and go from $100,000 to $200,000 of sales. Or we could work on our factoring. We could work on those intangible assets. We could work on the things which drive the true value of a company. It's easier, I would tell you, to focus on increasing the factoring. The ideas or the processes within a valuation which drives your company value as opposed to going out and increasing sales. It's easier. Let's give you a case in point. There's a huge disparity between publicly traded company valuations and our privately traded firms. Huge. Give you Apple, for example. I'm not endorsing to go out and buy Apple stock by any means, but let's use Apple because everybody recognizes it. I'm personally a Samsung guy, but if you're an Apple person, God help you. Apple has a stock valued at X, okay? Let's say it's worth $100 a share, which I believe is much more than that today, but let's say it's worth $100 a share. If we look at it and we look at our price to book, price per earnings, all those different calculations that price out that particular share price, we can have almost complete confidence that the market has priced it properly. Why? Well, we're going to dig into that a little bit more, but they have some things in place. For example, Apple has to abide by the Sarbanes-Oxley Act. We don't as small business owners. So I would dare say that Apple's financials are a lot better than my company's financials and probably your company's financials because of the way that they deal with on the auditing, et cetera, et cetera. If you took that and pushed that through the 8 key areas of business, which we're going to show in a second, then you could realize that whenever we look at Apple stock at $100 per share versus our stock price at whatever we think it's worth, there's a huge disparity there. It actually gets into an issue called company-specific risk. So the difference between your public companies and your private companies is that public companies are going to carry a lot higher factoring valuation. So go back to my simple illustration. You have $100,000 in revenue times a factor of 1. Our company's going to be worth $100,000, whereas a publicly traded company may be $100,000 times a factor of 3 to 5 because of the way the procedures and things they have in place. Whenever you deal with the relative risk of the marketplace, we realize we have the super large companies like Apple, large cap, big cap, small cap, micro cap, and then we have us small business owners, right, under $5 million of revenue. And again, there's Knoxville, that's kind of the demographic of the town we live in. Someone here may have a lot larger business, and you may fall in that middle market area. But what happens is the risk of our companies that we operate as small business owners have specific risks that only relates to us. And oftentimes, it's me. Oftentimes, it's the business owner. That is the largest risk. We're going to deal with the other areas of risk. The object to increase your valuation on your company, the object to kick Wall Street's teeth, so to speak, is to focus on reducing our individual businesses' specific risk. We have to drop the risk of our business. If we can drop it in such a format, we can actually reverse the mechanism and go to a higher valuation. So I put this on the screen for you. 2 different companies, same industry, same age, same product, same revenue, same EBITDA, net revenue, same market sector. Is one of those companies more valuable than the other? And that's the secret. If we just pause for a second, take a Selah moment here for a second, and we realize that there's an enormous tidal wave of exodus coming in the next 10 years. Enormous. If we realize that 80% of our net worth is more than likely tied up in our business, what are we going to do as business owners to increase our value so that it is best in class? So that when it goes against competition of the same demographic, same market sector, that we're getting the best possible valuation that we need. It's on the screen there in front of us. We have to create divergence. We have to create value within the underlying areas of business. So we're going to get into how we do that today. Does this make sense? Am I going too fast? I know I'm teaching a lot here. Yes? No? Yes? Okay. All right. When we get into value, though, what value are we talking about? Pick one. This is where I love talking to business owners. Oh, I got an offer. Okay, about what? What type of value are we dealing with here? What we're ultimately after is intrinsic value, by the way. That's what we want to drive, is our intrinsic value of our companies. If we increase the value of our companies, we do increase our net worth. And I don't know about you, but if you go back to that stock account, I know beyond a shadow of a doubt, because I've seen my reports in our companies, that I can beat the stock market in my business. It does not make sense to me for a stock person to come to me and say, hey, take your money out of your company and throw it in the stock market. That's ludicrous to me. It makes absolutely no sense. Now, there's reasons why you would do that. You get into cost of capital, you get into opportunity costs, you deal with taxes. There's some reasons why you do some of that, but it absolutely makes no sense to me for a financial world, Wall Street world, to come to us and say, hey, you're making a ton of money, Mr. Business Owner. I want you to pull all your money out and throw it over here in an annuity or in a 401k. Forget you. I'm driving the value of my company, my balance sheet, my net worth up. Because if I increase the value of my company, if I increase the sellable value of my company, then I can increase my net worth. I'm not going to dive into all the details of this chart, but some of you business-savvy people would recognize there's about 100 years worth of business development on that chart. In fact, I put a little link there if you want to just jot that down, the evolution of business operational management. I went through all the different convergence of the business world of the last 100 years, and it boils down to the bottom areas, the bottom 8 areas of that chart. So you've got Six Sigma, you got Lean, you got a little bit of all of them in there, the Japanese model. I mean, there's all inside there. If you get down to the bottom of it, it basically breaks it up into 8 key areas of growing the value of our organizations. Now, coincidentally, and it's not on here, but if you drew like a bullseye straight down, and almost like a parallax of a scope would be, planning and leadership, by the way, is typically your type D personalities, me, your CEO type personalities. Your sales and marketing are your fun-loving Jim Tatars. That just like to go, thanks, JC. JC said, I was actually talking to the fun person in here. That's the Jim Tatar, the type of people that just are the life of the party. That's typically your type S personalities. Your I personalities, your S personalities, your operational people. Those are the people that like to check out boxes. Hey, I like to follow a process. That's Miss Amy, part of our team members here, Miss Julie. Miss Angie's probably right there with me, type D personality. We like to charge hell with a water pistol. Your legal and your finance, these are your high C personalities. I call these my bean counters. They like to watch, this is Mr. John over here running the camera. They like to watch the ants crawl up trees. They forget the forest. We just want to look at the ants, right? So whenever you're dealing with business, we obviously are going to get to people in a second, but those are the 8 key areas of business. And by focusing individually on these 8 key areas, you can actually increase the value of your company. Because this is the backward side of the appraisal softwares that we would use to appraise a business. Think about playing the game of baseball. If you'd never seen the game of baseball before, could you put the rules together just by looking at the field? No. We'd run backwards. We'd run zigzag. And you're going to throw a ball and let me hit it? Why don't I just throw it at myself and hit the ball? We wouldn't know the game. We wouldn't know the rules to play. That's us business owners. We don't understand what drives our value. We understand how to make a sale. We understand typically how to hire somebody, I hope, okay? But we don't know what drives the value. More or less, we're getting mixed signals from Wall Street because they're telling us to take all our money out and throw it in there in the investment accounts, and it's end up hurting our net worth. So what we've got to focus on is driving the value of our companies here. If we do it properly, we can do a quantitative assessment. We can actually analyze where the company's at. We can tell you exactly what you should do and qualify each action. Believe it or not, one of our softwares, if I tell you, okay, you don't have a business plan, we need to implement a business plan, I can tell you the exact valuation increase by just putting a business plan in place. Some pretty cool technology out there today for us CPAs. It looks something like this. I think it's awful blurry. It's kind of small. But that's an assessment that I did on one of our clients. This is a real assessment. And those are the 8 modules. So you have planning and leadership, sales, marketing, people, operations, etc. The goal of the assessment to push our small business from where we're at today to best in class. Best in class, by the way, just think of it this way. Don, you can go to other companies within your industry and tell them exactly how to run the sales department. I mean, you're actually speaking at conferences. You're best in class when you get to that level. What the object is to drive our company's value, each of these areas, each of these 8 key areas, into that 60 to 80 percentile. If we get to that 60 to 80 percentile, you've now come over the bell curve. You've now moved into your higher valuations. So we have to dissect the company in those 8 key areas and see where we're at today within the organization. Once we take a pure assessment, then we end up getting a company-specific risk score. This is the backward side of the valuation report that you may have seen. We go in and we know exactly what your risk is for your company as it relates to your SIC code within your particular industry. The object is, just like we talked about with Apple, the object is to drop the company-specific risk score from this particular client's 186 down. If we do that, then here's the reality. I can actually show this client who had a $1 million net worth that in 3 years' time, if they followed the recommendations that we ended up implementing, that they can double their net worth. So I made a statement a while ago, and anybody in the financial world is like, you're full of it, Justin. You can actually double, as a business owner, your net worth every 3 to 5 years. Now, it's not easy. It's a heck of a lot of work, but you can. This is a real client. This is the real numbers. He went from 1.1, by the way, he's greater than that. Because what I'm showing here, and this is where it gets kind of crazy, what I'm showing here is just straightening out the water hose. What I'm showing here is not chasing additional revenue. This is without any additional revenue. This is holding the top line sales the same. This is just dealing with the way the valuation software works, the way that the hedge funds, the way that the venture capitalists right now are throwing out serious dollars to the marketplace. This is what they're looking at. They're trying to see the reduction of company-specific risk. So whenever we business owners hear the corporate execs come out and say, hey, go chase sales, if we're within that 5 or 10 years of trying to sell our business, you could actually damage the value of your company. But if we work on the intrinsic underlying opportunities within the company, those 8 key areas, without increasing the sales of the company, we can actually double the revenue. Well, Justin, does it work? Yeah, it does. I'll take it one step further. As you become more efficient in those 8 key areas of your business, sales come. And so what you then have is a multiplicative increase in your business. So where I was showing a $1 million to $2 million value growth, it actually goes from $1 million to $4 million. So whenever I stand and say, our small business owners who engage us for value services, I can look at them and say, yeah, we're going to double your net worth every 3 to 5 years. It's going to be really hard, but we can do it. It's probably going to be greater than that. Well, Justin, how's the economy working that? Yeah, we can factor all that in. We can still run the same numbers. But most of us don't think that way. Most business owners do not think the way I'm talking. This is what we think about. Those are our concerns. And as we're thinking about that, another day goes by, another week, another month, another year, another decade, and now we're 65, 66, 67, telling our mountaintop story, but no one's interested in buying our business. Or they're interested in buying our business, but now we're in that 3 to 4, we're not in that 3 to 4%, and we're not getting what we think it's worth. We're having to make concessions. We're having to actually guarantee the sale of our business on a personal note. That makes no sense to me. That's the highest risk thing we could do as business owners. But that's what we do because we focus on the things that don't matter. See, we often hear the statement, us business owners, and I'm guilty, we have a hard time working on our business because of these issues here. So let's dive into what makes it tick. I could go as deep as you want to go. I'm going to try to basically say this is a motor, this is a piston, this is a carburetor. Okay, I'm going to keep it super simple today. And I'm going to do it through questions. Whenever you go through value growth, whenever you're in a business owner position and you say, okay, I want to retire, I want to sell the company 5, 10, 15, 20 years from now, the goal is to look at the 256 points that the top valuation softwares use and backwards engineer it. Okay? And by backwards engineering that software, we know exactly what to do to increase our value of our companies. And by increasing the value of companies, therefore we increase our net worth. And we also make it where it's sellable, where someone wants to buy our business, where our business is not mixed up in the fray with all that flood of business exits that are coming up in the next 10, 15 years. So let's dive into each of these categories, and I'm not going to read all the questions on the screen. Planning is pretty simple. Planning is the heartbeat. If I were to ask the question, how many business owners have a fully written, fully integrated business plan? 1 out of 10 would answer that question. Yeah, we have a written one. Okay. When's the last time you updated it? Typically it's out there somewhere, but why does it matter? Because the software, that's the way the appraisal softwares work. That's just an example. So whenever you look at the planning area, you're trying to identify specifically who's your target market. Would you have a strategic plan in place? Strategic plan is a whole fun thing. In fact, we're working on a course right now that takes a business and puts it into 90-day sprints for strategic planning over a time period of a year. And in that year, you're going to accomplish 27 specific actions to drive the value of your company up. I can't wait till that course comes out. What we're looking for in planning are these key areas that it's on the screen. And in each of these areas, it drives the value of our company. In leadership, we're ultimately trying to make sure that the business is not centralized around you, the business owner. So I'm going to make a statement, and I realize it's going to sound crass, and I'm sorry in advance. No, I'm not really. If you, business owner, cannot leave your business for 30 to 60 days, and the business continue or grow in revenue, then you're not a business owner. You're an overpaid employee. A true business owner has put a leadership in place where that business can operate without them. That's the goal. That's a lot of work to do, but that's the goal. Well, Justin, can you do that? Not yet. I'm not trying to sell my company yet. 10 years, we're going to get there. I'm not trying to sell it yet, but that's the goal, friends, is to get through our leadership capabilities to where that business can operate fully intentionally and grow without us being involved. There's a member in the organization here with Legacy Center that a couple years ago we were talking about creating a mini-me and actually taking some sabbaticals and trying to figure out how to get the company to operate without them there. It's fun to watch whenever a business owner gets that mindset and what can prosper in their particular business. It's pretty amazing to watch. Sales is real simple, if you really think about it. Sales is whenever somebody calls or reaches out to your organization, the yes is in best of class. So if the average business, whatever your industry you're in, if you have a 5% retention rate or 5% conversion rate, you may be, for best in class sales, you may be a 7% conversion rate. In order to have the sales process move through those various questions that are on the screen there, you have to first develop your marketing plan. If I could put the number 2 thing that I see as a flaw within businesses, and I've seen, if not 1,000 different business plans, is that we don't know who our target market is. We shoot to everybody versus nobody, and it ends up being nobody. If you can figure out who your Frazzled Frank is, who's Frazzled Frank? Frazzled Frank is a business owner who produces between $1 and $5 million a year in sales. They typically have 5 to 25 employees. They're in the service industry. They're not in manufacturing. They're not in retail. They're in the service industry. They do have an executive administrator in place. They're typically Christian. They're typically conservative based. They like to hunt and fish. They're my people, right? That's my Frazzled Frank. If you can identify who your Frazzled Frank is in your particular business, then you can build and draft your marketing plan, have it written out, have all the different positions in place that can increase the value of your company. But most of us don't. Most business owners, they can fog a mirror, we'll work with them. It's dangerous. That's why we don't sell our businesses. People is the individuals that we utilize as business owners to help the business grow. Okay? It's the team that you put together. We have a rock star team. It's been intentionally hand-selected to fit personality profiles. My job in my companies is to hire people who are so much smarter and better than I am that I end up being the dumbest person there. That's my job. Because if I can do that, then I have a company that doesn't require me to be at the center of it, right? Whenever you put your people component together in your organization, it's not just hiring those individuals. Here's where it gets tough. It's making sure those individuals see the vision and the culture and the direction of the organization, and during a transition, they're going to stay during the transition. Think about it. Let's say that you were an investor and you were going to buy my company. There's 7, 8 members of the organization here today. Let's say you were going to buy the company from Heritage Investors, and the day you bought it, 5 of us leave. We're not working for you. What does that do to my value? It kills my sales price. So the object is not only to grab a superstar team, but to have that team committed to grasping that vision and rewarding them handsomely, by the way. Maybe it's stock in the company, maybe it's phantom stock in the company, something there. But you're trying to get that team motivated so they're pulling with you. Does anybody know what a mule day is? Mule day. So I went to a couple mule days in my life. I said, again, dumb redneck, right? My dad took me to a mule day with Milton Lynn. And there was we call it a super Clydesdale. It was a half Clydesdale, half donkey. This thing was unbelievable big mule. It was a crazy mule. This mule could pull a 700-pound plow. I mean, that was pretty impressive. But I remember watching whenever they hooked up another mule side by side to that. You would think that 2 mules could pull 1,400 pounds. They pulled almost 3,000 pounds. It's amazing. When they hooked up another mule, 3 mules, the number went almost over 10,000 pounds. The moral of the story is not your team's not a bunch of mules. Well, I've got one on my team that might be. The moral of the story is that your team's not a bunch of mules, but if you can get your team pulling, focused in the right direction, pulling in the right direction, and then get out of their way, then you now have the culture and your people set that the company can increase the value. That's one of the hardest things we have to deal with as business owners. Because you're dealing with people. And by the way, I'm not the best people person. Everybody here would shake their head yes who know me. Operations typically is the strongest position of a company. Typically is the best, the highest scoring position. Why? Because we realize we've had a lot of consultants come in who understand lean, understand process orientation, understand a lot of these different techniques. We go to trade shows and we say, how can we increase our throughput? Right? So operations typically is very strong. It's typically strong because the business owner has had to, who's typically a high D personality, has had to lean on and move those away and hire somebody in or do a lot of education to bring that particular skill set up. So operations is typically very strong. You're working on a number of things there. The ability to scale is the most important thing in operations. The ability to scale, what's that mean? You get a huge influx of orders or a huge influx of clients, the ability to increase the capacity, or the opposite. We could be going into recession. My crystal ball is broken. I'm not saying we are. We could be headed to a recession, though. I think many of us would recognize that the storms are on the horizon. What happens if we have a retraction of our flow? The ability to scale backwards without hurting the operations of the company. So many people go out and they put themselves on huge debts right now. They're borrowing and building these big buildings. They're buying a lot of operational equipment. And now when the retraction happens, they're going to get in financial straits. So you have to scale both ways. Finance is one of my pet peeves. First of all, I'm not a really good finance guy. I'm a pretty good planner, I think. At least people in the media think I am. There's a lot of CPAs that have fallen victim to their industry. If you can find a CPA CFO or a CPA or an accountant or a CFO type personality that doesn't work only on compliance within your business, then you've won in this world of finance. I get so frustrated by CPAs because all they want to do is tax forms or payroll or bookkeeping. Guys, there's software that does that for us now. What we need as business owners is someone to calculate hurdle rates for us. What we need as business owners is someone to look at our pro forma and say, hey, you've got some problems out here. Here's what you should expand to. Here's where you go to the Ansoff matrix of your business, and here's how you push that product out. A true CFO. Most business owners stay at a CPA and they say, I got an accountant. You're missing the boat. You're missing the boat. Finance, even though it's one of the strongest scorings that we would score ourselves on because we have an accountant, it's often the second weakest because we're not looking into the future and building multiple paths to deal with the growth of our company. Case in point, informational systems. Most of us would have a CRM, I'm assuming. Most of us would have an operating system that we use within our organization. It's not the operations department to deal with that. Yeah, they can enter data. What you have to convert is that CRM, that operational data, into revenue and show how the revenue is going to end up working in the company. Case in point. How many CPAs do that? The legal world is fun. It's usually a very strong one. Where I see the weakness in the legal world is whenever we're trying to retain those targeted key employees or key team members. I don't like the word employees. I definitely like the word staff. I think staff's an infection. I like team because everybody's pulling together, right? So, but whenever you're dealing with the legal side of a team members, you want to have the contracts in place. I'm talking as a business owner here. You want to have the contracts in place to make sure that the team is committed through the sale. So if you're within 5 or 10 years of exodus of your business, the key there to drive the value up is to make sure I'm using the term golden handcuff, that's a technical term, you're handcuffing with benefits. You're adding some true value to those team members so they go with you through the sale. Because if you sell the business, more than likely you're going to have to stay on for a year, maybe 2 years to make that transition work, okay, depending on what industry you're in. So all that boils down to this particular graph, which is probably blurry again. This was the client. They scored okay in some areas. Their legal was strong, which is that bottom number. Their sales were strong, and their planning work was relatively strong in this client. Their weakest area there was their people, their marketing, and their operations in this particular client. We went through and we did an assessment. They were worth $1 million. That was the value of this company when we started. Their net worth, by the way, was $1.4 million. Okay? So you can see the value of the company was the majority of their value. Okay? After one cycle, this was their new score. We just assessed again. Their net worth went from $1.4 million to $4 million. And guess what? After that 3-year cycle, they can do it again. And they will do it again. And he's got probably, 4 years before he sells? About 4 years, and he'll sell, and his net worth is going to be greater than $10 million. That is value growth. Now, the goal for us business owners, or the goal for the individuals that you know are business owners, is to close the gap. If 80% of our net worth is our business, like we just saw with that individual, we're not going to close the value gap and move an illiquid asset from a stock position on a balance sheet over into dollars in the bank, dollars in a true portfolio earning 4, 5, 6%. You're not going to move it from this position to this position without having a plan to drive that value. And in order to drive that value, you have to look at those, you have to dissect your business into those 8 key areas. Planning, leadership, sales, marketing, people operations, finance, and legal. You got to separate your business into those 8 key areas. Look at almost like a SWOT analysis. You can do this yourself. Do a SWOT analysis on those 8 key areas individually and see where you're weak in. And then when you look at those 8 key areas, wherever you're weak in, score it for yourself, however you think. Get it outside your board of advisors that I know everybody in here has, right? Your board of advisors. Have your board of advisors look at it with you and say, now what can we do to increase that particular weak area? If you want to do it from a professional level, we use software to close the gap and ultimately get that business where now, whenever it goes to marketplace, or like one of our clients had happen this last week, whenever someone calls you on the phone and says, hey, I'll give you X number of dollars for your business. Yeah, that's not enough. We know we're ahead in 2 years, brother. Double that, we'll talk. So you'll be able to change that perspective from only 3 to 4% of us being able to sell our business for what we want to now being market ready. We close the gap. We don't become a statistic. Okay? Any questions? It's a lot of information. So I told you, if you were not going to hear another Wall Street guy talk this way. Okay? Any questions? No? All right.
Surely we have some questions. Don't be shy.
Yes, sir.
Here's a generalized question. Okay, for example, Pilot is a privately owned company. You agree with me, right?
I don't think so, because of the Buffett, I don't have the data on there, but because of the Buffett acquisition, I don't think they're no longer private.
It was 20%.
Yeah, Warren Buffett owns 20%. Yeah, Berkshire Hathaway.
Okay, what is, maybe it's totally too generalized, what is the best way to go, especially as Powell was growing before Buffett got involved in it, be a privately owned company or be a publicly owned company?
Okay, I follow your questions. Let me ask the question differently and see if I'm on the same page with you, okay? If I'm a privately owned company, should I consider going public? Is that a reversing of the question? Okay, so what you're dealing with is, yeah, a lot of variables, IPOs, things of that nature. In order to go public, you have to be best in class. You have to be that company. In order to get a good stock issuance, you have to be that individual who's able to go to your trade show and speak as an authority on those 8 key areas of your business. Unfortunately, in the small business market, which is where Knoxville's predominant market is, Pilot's by no means a small business. In fact, they're not even a middle market business. They're in the large business quartile. But crap, and I see some middle market businesses that they're just not ready to go IPO'd. Now, can you go IPO? Yeah, you can. Just got to go to best in class. And if you go IPO, have fun with it. There's some valuation. I mean, Snapchat, crap, they got to make what, 54% return on their stock price for the next 10 years in order to confirm their current valuation? It's ridiculous. So yeah, if you can go IPO, have fun with it. Make some money. But most people aren't ready. Most people can't even sell their business to another person and own or finance it because we're too busy working in it versus working on it. Yeah.
Most people fail in IPO because they're ahead of themselves, is what you just said too.
Yes. You simplify what I just said. Yeah. Yep.
When I'm looking at that list of things you talk about addressing, I would count myself, and I'm sure there's other owners here who would look at that in the same way, and just recognize how daunting the amount of work and the amount of time it would take to tackle this. How do you get there?
How do you eat an elephant? You ever heard the old saying, how do you eat an elephant? One bite at a time. Yeah, so as a small business owner, we have to look at those 8 key areas, and out of those 256 points that we can analyze, you have to prioritize them. In fact, let me get to that slide here. I think it's right here, Russell, to your point. If we prioritize them, you see over here it says level 1, level 2, level 3. It's knowing how to rank and how to sort those 256 points, the way the valuation software, backwards engineering that and saying that if you focus on, I'm going to make something up, finance, legal, operations for your business, JC for your business, people, marketing, and sales, Cliff for your business, finance, legal, planning. It's knowing in your particular business, out of those 256 points, how to arrange that. Fortunately for the professionals, we have software that tells us how to sort it out and shows us the results by ordering it, and we can play with that order and see the defining results. Then once you have those results, then you give, what we do is we do 2-week assignments. We actually meet with clients every 2 weeks and say, okay, here's your assignment for this week. We need you and your team to focus on just this one thing. The next week, here's just one thing. And as we're updating those ideas, we're going into the software and constantly increasing it, constantly marking off and keeping that valuation moving forward. That's the only way you can do it.
So as you're dealing with these hard-working, long-hour owners who really don't have time to work on their business, you're still asking them to set aside enough time to start chipping away at this. And do they ever supplement their resources? You know, the people it takes to plow through all of this?
Yeah, most of the business owners who we're dealing with on this level, revenue is not an issue. They're making enough to draw a T chart like the Power T, University of Tennessee. I promised I wouldn't make any comments today as a Georgia fan, but draw a T chart. Most business owners, we have a standard of living that we utilize. So let's say that, like my family and I, we spend about $60,000 a year to live on. We very, very meager lifestyle. So if I make $200,000 in the business, what I can do is I can take that portion that I don't live on and invest it back in the business as opposed to Wall Street. If I invest in the business, it may be where I hire some strategic people to come in and shore up a position to work with you in that one area. So a lot of the business owners, they're not bootstrapped. The ones that end up having to do this type of work, they're providing their base level of needs. Now they want to grow the value. So they've hit their basic flow. Does that make sense? And then they supplement with people. They supplement with software. They supplement with third parties. I may say, hey, call Cliff. We need some insurance in place. Hey, Cliff, here's what we got to do, buddy. And that may take care of that one little area inside there. So you can supplement it with technology people, suppliers, et cetera. Yeah. Thank you, guys.